What's up, Outliers? Happy Friday. Welcome to Outlier Options Trading Foundations. Today, we are continuing on with our mini series. Our first episode was last Friday. Let me grab a screenshot. I think I have a screenshot of the actual agenda somewhere, maybe. Thought I did. I can find it. Oh, this is it. Oh, that's super full screen, that's for sure. Here's our agenda. Right now, we are now episode 2, using the Greeks to guide decision making. Now, first episode, we focused on taking an idea and getting that to the point where you're ready to research, then place a trade. Once we get that trade in mind, we now need to determine what kind of trade makes sense for what we're looking at. So we are literally going to pick up directly where we left off on the last episode. If you missed it, you could check it out in the description. I'll grab a link for you guys in case you didn't get a chance to catch the last episode. Now, the broader purpose of these is trying to help people connect dots. A lot of what you do in trading can be a little bit challenging because you have to pull together a lot of different pieces, and then you got to make sense of it and do it in a way that hopefully is profitable. A lot of people struggle with doing that, rightfully so. It's not something that just naturally occurs. One of the other issues that people will have is even if you have a good idea, your good idea can be undone, especially when we're talking about derivatives, in poor choice, meaning we're using structures that don't make sense. We're not able to fully capture the concept that we're trying to. This is actually something I was literally just on a coaching call not that long ago talking about this exact thing, because we were talking about post-earnings announcement drift. And the original idea that they had really wasn't tailored to capturing the effect that they wanted to. And this is super normal. The reason why this happens is because it's difficult for our brains to completely segment something that we don't fully understand. That's the challenging part. The cool part is it can be done. So let's talk quickly about the Greeks. Once I get through the Greeks, what I want to do is work through a practical scenario with you guys. The practical scenario I've listed in the chat. I'm essentially looking for you to give me a couple structures / strategies that we want to use for creating a practical example to work through this. One last admin note for those that are interested. Twice a month on the first and third Monday, the Pro Plus members, we do a Zoom workshop. And I always open up a few seats to the rest of the community. And it's just because I know not everybody's at a spot to be able to afford the tier, but I still think the value is obviously useful. And I try to build different ways for those kinds of people because I was that guy. So I always have that in the back of my mind. A small offshoot of that, I used to try and get books, and it's such a fascinating thing to think back and consider because I used to try to get books from friends. I used to try to get old editions from the library that they were getting rid of. I used to use copies that people sent to me via PDF. And it's fascinating because it is so far from my radar. I look at what I would do now, and I literally would actively step over a free version to get to the paid version so that I can pay for it. But I very, very much remember where that $25 on that book was going to come from something. And that was always a tougher decision to make. So that's a big reason why I do this for folks is I really do remember being at those different points in my own life. So anyways, if you're interested in trying to grab one of those seats, I'm throwing in a link to a post. It's free for everybody to access on Patreon. The only thing I'm asking for is you to tell me what you're working on. If you tell me what you're working on, that's the submission, and then I'll just pick a few people. I do it at random, except last time I cherry picked one person that's been in the community for a long time that I've been trying to help for a while. So that was an anomaly. But other than that one completely, I don't even want to call it nepotism because it's based more out of like sadness and human concern than nepotism, but I guess it's still a form of nepotism. Joe, you're part of the community, but you're kind of like you're kind of like the bastard child that is here but struggles. Sooner or later, it's going to click, I think. Announcements aside, let's talk about the Greeks, shall we? If we open up an options chain, happen to have Tesla up, so this will work great. We notice there are a lot of things in this options chain. I actually remember the first time that I opened up one of these and it didn't have all this shit. It literally was just like bid ask, maybe delta and something else, like 3 or 4 things. Even that was overwhelming. And then you look at this stuff for a little while and it really becomes highly intuitive. I make a point to mention that because if you look at this options chain, you're like, what the fuck is that? That's okay. It's just new information. Every time you see some sort of new information that you've never seen before, it's not immediately going to make sense, but it can make sense. Just give it a little bit of time. In these options chains, we can derive a ton of data to help us build trades. So if we take a step back and we get to a quick recap of some fundamentals. Now, I have a ton of videos on the Greeks on the channel. You can find all sorts. I think I just released one this last weekend before that about theta decay or something like that. So I'm always talking about the Greeks because they're widely misunderstood and they're absolutely essential to our decision making. I want to just recap them super quickly. There are these primary Greeks, delta, gamma, theta, vega. I call them the primary Greeks because they really all pertain to the dominant force of an option, which is its price or change in something else that measures premium change from price. I'm referring to gamma there. These are not all first order Greeks. That's a common misconception. It's pedantic. It doesn't matter. First order, second order, third order, beyond understanding that those different orders measure different things. That's all. That's why there are these orders of Greek. So if we look at the first orders, we can see that there's delta, theta, vega, rho. You don't see rho a lot because it tells us the rate of change per 1% change in the risk-free rate. Rates just dropped. Notice how this says premium change from a 1% change in the risk-free rate. Rates dropped 25 bips. So that amounts to very little overall change. It's something, and if you have a big enough position, it's certainly meaningful. But because rates don't change that frequently, and because the change is not that significant, that's why most of the time, most of us that trade options don't focus a lot on rho. It's good to know it exists, what it does, but it's not that dominant of a force. The most important from this list, hands down, delta, theta, vega, and then gamma. But notice how gamma is down here in the second order Greek bucket. The reason why it's down here is because gamma is the only out of the primary Greeks that measures another Greek. For the first order Greeks, they all measure changes of price, premium, with respect to something else. So delta is change of premium per 1 point move in an underlying. Theta, passage of 1 day. Vega, premium change from a 1% move in vol. Those all directly pertain to, and by the way, in case you didn't know, they're not all Greek signs. I have no idea the history behind that. I haven't gone down that rabbit hole, although I've gone down a lot of trading rabbit holes. I've not figured out why they called it Vega versus Kappa. Like the equivalent here would be Kappa. I think it's just Vega volatility, theta time, delta direction. I literally think it's that simple, but I'm not positive. And I want you to know that I'm not positive. Just my best guess, which is, it's kind of fun. The fact that it's like that elementary, but anyways, Vega isn't a Greek. Anyways, Vega tells us change of vol, and then gamma. Gamma is the only one out of this list that tells us how another Greek, delta, changes. And then you'll notice that there are other second order Greeks. There's something called charm that most people are completely unaware of, but it impacts your options. And I'll show you. If we take a look at this little plot here, this is looking at the very same spot price, same point in time, but looking at different expirations, same strikes across those expirations. Quick admin note, if I say anything that doesn't make sense, please tell me. That's why we're doing this on a live stream. You're not interrupting me. I will do my best to glance at the comments and then come back over, but do not feel like you're disrupting me. I'll find a slot to piece it in where it makes sense. But if, as I'm saying something, it doesn't make sense, please tell me, because I genuinely don't know if where everybody is at. And I do my best to keep it at like a decent level, but if I don't have to go down to the bottom floor, we just move a little bit quicker. But I'm always happy to go to the bottom floor. If somebody doesn't know what one of these things are, just tell me. Okay. Notice how same strike, same spot price, looking across different expirations. Take a look at the shape of delta. What do you notice? You should notice a very important gap that exists here and here. What's happening? What's happening is, as time is passing, your delta is changing. It's literally converging like this. That's exactly what's happening. This is your delta. So this is a delta of 1. This is a delta of 0. The at the money strike is right here. So what's happening is the out of the money options are approximating towards 0 as time passes, as nothing else changes. So what that means is I can have a 50 delta option today. Let's say this is 35 days out. Let's say ceteris paribus, nothing else changes. Let's say that there's now 5 days out. Is this option still a 50 delta? Maybe, because 50 delta is right at the money. So if nothing else changed, that actually could be still at a 50 delta. What I'm showing you is this section right here, this little pinpoint that everything else is spinning around. That is delta, and that's at the money. Now, if it's anything other than this, if this was a 50, I can't really see that, sorry. If this was a 52 delta or a 48 delta, they're moving. The 48 delta is losing deltas. The out of the money option is losing deltas. The in the money option is gaining deltas. As time passes and as nothing else changes. This is what charm is. And it confuses a lot of people because they think delta does not decay. I've actually had people comment directly on videos with that exact statement, that delta doesn't decay, only theta. And it's completely wrong. And it's a fair assumption. It just stems from a lack of understanding. So why does this matter? Because if you buy an option that's in the money, as it gets closer to expiration, if it's still in the money, it's going to gain deltas. If you buy an out of the money option, as it gets closer and closer in time, your delta is going to drop. Let's visualize this together. Real-time data, and we'll plot it so that it's easy to see. First things first, we got to find a section in here. This works great. So what I'm going to do is I'm going to find something, I'm going to pick a spot price, and I'm going to pick a strike price. The strike price is going to be the same, but we're going to have different deltas across expirations, which you'll see. So the way that this will work is we will also have a term. So down here will be delta, And then over here will be term. And we'll have a little bit of a matrix, matrix situation going on. So let me move this out of the way. Okay, since we're in Tesla, I'm not going to use Tesla just because volatility in here is kind of weird. So I don't want to confuse people with other factors going on. Let's go to 15 Jan. So this is 441 days. 441 DTE. The strike price that we're going to look at is what's also close in time, just for an easier reference. Let's do the 700s. Okay. So the strike that we're going to look at is the 700. Our delta for the 700 this duration out is 0.56. And again, this is all going to be for the same strike. Let's go in to like 90 days. We don't need a ton of points. This next one is going to be 91 DTE. That 700 is now 0.42. Let's go in now to like 30 or so. I see 28. That's close enough. This 700 is now 0.26. Let's now go to 7. That 700 is now 0.04. And then let's go 3 days just because it's here. 3 DTE. 700 is 0.01. Cool. So what I just showed you is the very same strike option across different terms. Yet there's a very, very clear trend of delta and how much delta is there. This is the same strike across different expirations. These are the kind of things that fuck people up. Because if I buy an option that's short dated, take a look at the difference between these. So what I can do is I can create a bit of a system here to help me understand the relative changes. So I'll show you how to do that. This, by the way, is a completely different direction than I was going to take the session, but your boy's always happy to talk about some charm. So what I'm going to do is I'm actually going to plot the difference between these. I want to track the change in days. So we go from 350 to 63 to 21 to 4 to 3. The reason why I want to do this is I want to show you the change in delta between these. And then we can figure out delta per unit of time. So delta, here's your change in delta for these different changes in duration. Now from here, I can say as a ratio, and again, you can do the ratio however you want. You can do how much delta per day, or you can do delta by time. And then I'll turn these into percents just because it'll be a little bit easier to see. So what I just did here is normalize the rate of change of delta across these different terms so that then we can figure out where the acceleration is super high. So notice how between 441 days and 91 days, that's a term of 350 days. Yet your delta changed by a total of 0.14. So on a per day basis, your delta is effectively not changing, not much at all. Then you'll see when we go from 91 to 28, we lose 0.16 deltas. That's fascinating, isn't it? because we changed 350 days, but we had less change in delta. But then all of a sudden, we only change by 63 days, and we change delta by 0.16. Massive change. So what is that? What does that tell you intuitively? That charm is accelerating in here. So even if you don't have charm on your chart, you can have an intuitive understanding of how it behaves. Let's go now between 28 and 7. That gives us 21 days duration. Take a look at the difference. 0.22 change in your delta. That's almost double what 350 days change was. What does that tell you? It's getting more sensitive as we get closer in time. Then all of a sudden, something super interesting happens. Going from 7 to 3, it goes down. Who can tell me why it went down? Does anybody know? Who knows? Less absolute value left. That's exactly correct. Good job, Reese. That's exactly what it is. So the reason why the rate of change of delta plummets as we get into this really near-term change in term, there's less delta to go away. So let's visualize this. From 7 days to 3 days, we go from 0.04 to 0.01. We're already effectively at 0 delta. 0.04 is already, we're there. We're at effectively no deltas. So there's less that can actually come out of this. You only have 0.04 that can go away. Whereas you have a lot of delta that can come out in this duration. Why does this matter? This matters because when somebody like me is trading ratio call diagonals, where I'm long an option that's typically 60 days, normally 90 plus, sometimes as far out as they can possibly go if it's a longer term play. Another key reason why I choose in the money options is for this factor. Because if I hold something for a month, I put myself in a very tricky scenario. What's that tricky scenario? Let's think about it. Let's say I bought these options 441 days out. And let's just say that I held them all the way to 3 days. Let's say that I bought this option. Let's say that the premium out here was $1, right? Cheap option. If we go forward in time, as time is passing, this is decaying by theta. So let's say the difference between 441.91, everything else remaining the same. Let's just assume something. And let's say that your option is now worth 90 cents, just an assumption. Well, what's the problem here? The problem is not only did I lose value in terms of the option itself from theta, but I've also lost delta. So when I do get my move, it means I get less of it. Because in this scenario, if the underlying goes up $1, I make 56 cents. Now I only make 42 cents. This problem becomes exacerbated as we get closer in time. So you can find yourself, let's say in this scenario, your option is now worth 50 cents. You've lost 50% of your option and you have 20 days left to go. That's not really how it would look, but it's fine enough. And let's say at this point, you did get that change. And let's say that the underlying goes up by $5. Pretty big change. Again, relative to what spot price is, we're not using $700. But pretty big change. Yet this 5 points in terms of premium at this delta is only going to give me 1.3. So I'm going to get something, but I'm not going to get anywhere near as much. And a lot of this $1.30 is going back into giving my money back, going back to break even. Now, again, gamma would accelerate this slightly. So maybe your average delta change isn't 26, but maybe it's like 30 or something like that, just to simulate your gamma impact. The point I'm making here is that if we bought 441 days out, we do nothing. And let's say we're at 28 days now and you start to get your move. The issue there is a good part of that move in this scenario, again, just call it 50% or so, 40%, is going back to just getting you to break even. You're not in profit yet. Then after you get back to break even, then obviously you're in profit. This is super common if something is oscillating sideways and somebody continues to hold. This is why options are so nuanced. Reese says, what exactly causes charm? Time? It's a great question. Charm is, if we go back, it's this function. It's the relationship of time with spot price and your strike price. Delta represents moneyness. If we have something with a delta above 50, it's in the money. Technically speaking, in the money. Now, there's also a relationship between strike and spot, where in this case, delta is 56, but it's actually out of the money. Why is it out of the money? Because of volatility. This far out, there's a difference between what's called at the money and at the forward. Forward is taking into account the forward expectation of growth, vol, drift, those kinds of things. So the relationship between spot and strike is the ultimate arbiter of moneyness. Even though a lot of people would assume 50 delta or higher is in the money. It's not always. But what's happening is as we get closer and closer to expiration, the probability of this option, the 700 strike, ending up in the money goes lower and lower and lower and lower. So the way to think about it is right now, SPY is at 682. What is the probability that before expiration, 441 days, SPY trades above 700? Probably moderate. What's the probability of it doing that in the next 3 days? Much lower. It has way less time to make that move. And this goes back to this function, which is all in the money options are approximating to a delta of 1 being in the money. All out of the money options are approximating to a delta of 0 out of the money. Now that we have our trip down really rabbit hole, down charm, what questions do you have? Then we'll get into using the Greeks to actually make decisions. This is a decision, by the way, so it's on brand, but it is a little bit different. Lauren says, can you zoom in? Oh, yeah, sorry. Let me know if this isn't zoomed in enough. Afghan Battle Rat, great name, says, any thoughts on GameStop options? We can take a look at those tomorrow. Today, we're going to focus on this more like fundamental concept. Lauren asks, can Delta go back up? Definitely. So the way Delta goes back up is if the underlying goes up, appreciates in value, and let's say that the option then falls in the money, then the delta is actually systemically going to go up because of the same effect. Charm is known as delta decay, but it doesn't just decay. There's an element where delta can expand. It's much more similar to raw delta in that way. Kirk says, is charm a measurable number within TOS? Definitely. I don't know specific, well, it's not, I don't know if TOS has a column for it. You can calculate it. It's not easy. or I'm sorry, it's not difficult. The way that you calculate charm is literally by what I was doing here. This is how you derive what charm is. This is effectively what charm is. This is the change of delta per unit of time. This is charm. That's what this is showing us. So you can calculate it by doing this approach. Now, one assumption here, which isn't accurate, but it's close enough, is this is assuming a linear slope. So what this is saying is each one of these 350 days is treated the same in terms of its impact on the change of delta, which we know is not true. We know it accelerates as you get closer in time. But unless you're managing a really, really significant size book, it doesn't matter that much. But you could add a curve to it. It's not difficult to do that either if you wanted to be more accurate. But yeah, you can definitely measure it. There's not a ton of utility to be completely forward. It's something that's good to be aware of, but one of the easiest ways to measure it is literally just doing what we did here in this exercise, is just flipping between the different expirations and eyeballing the same strike and seeing, where that starts to like really peak. But again, that is one of the decision points when I'm trading ratio call diagonals, because if I'm planning on holding something for a month or two, what I don't want to do, we can use a practical example really quick. Let's get rid of these terms and let's just look at closer term stuff. So let's say that I do these 91 days, and let's say that I start at the money. Let's say that I buy the 682s and I get them for a 55 delta. So these ones are 91 days. And this is a 55 delta. And let's say that I'm planning on holding for 60 days, whatever duration I think that the profit mechanism tends to last. Let's say that this is just momentum. So let's say that takes us into like 28 days. If I look at that same option, the 682, and then I look at the 682 here, my delta is still at a 0.53. And this is now with 28 days. So not really some sort of massive gap in my delta. Like it really didn't change much at all. And that's because I'm at the money. Now, again, to elucidate the point further, let's say instead, when 91 days out, I decide I want a 30 delta option. I want to go a little bit cheaper, and I'm hoping that I get a compounding effect. So that puts me at the 715. The 715 is effectively a 30 delta. If I go to 715, 30 days out, my delta here is 0.09. Huge change. Huge change. So this is a deciding factor. If I'm trading a ratio call diagonal, I can tell you exactly what I'm not going to do. I'm not going to buy an option that's 91 days out at a 30 delta, planning to hold it for 60 days. Not doing that. Does that mean that I don't buy the 91 30 delta? No, that can still happen, but maybe I need to manage it a little sooner. Maybe I need to roll it out in time after 2 weeks pass, a month passes, but definitely not holding it for 60 days. That is how charm can catch people off guard, because in this kind of scenario, as your premium is declining, the corresponding move you now need to get back to break even is going up and up and up as you're losing deltas. That catches a ton of people off guard. So let's now take a look at using some of the basic Greeks. I'm actually going to add this as a follow-up to do a video on charm specifically, because I think it'd be useful. Okay, so now it looks like Lauren brought up a straddle. I think that's perfect. And let's say that we decide that we want to sell a straddle. And we know that a straddle is going to have certain behavior. We can look at selling and buying the straddle. Both of them really, we can look at the same scenario twice. Let's say that we think volatility is going to expand in SPY. Let's say that our assumption is right now vol is low, even though vol is kind of high. It's at 57%. But let's just pretend for the example. Let's actually say you're not used to the outlier method of trading, and you haven't watched my video on IVP versus IVR and why IVP is so much better, and you see an IVR of 10, and you think with this IVR of 10, vol is really low. Again, realistically, it's not. IVP is like 57%. Vol is actually quite high. But if you didn't know this and you use IV rank of 10, super low. So you might think that vol is going to go up. Again, it's the wrong assumption here, but just playing it out. We can choose to buy a straddle. Now, when using the Greeks to make a decision, the way that I think about it is first focusing on the profit mechanism and how I think that profit mechanism behaves. And that comes from doing the outlier strategy process, which I have a video on, which effectively means analyzing the profit mechanism, how it tends to behave. So for example, that could be looking back at SPY, looking at periods where volatility was in the 10th percentile. Let's pretend it was IVP is 10, not IVR, and how long it tends to stay down there before it starts to expand, something like that. And let's say that it typically takes 20 days for it to expand. Okay. So when I'm thinking about in this scenario of buying the straddle, because I think vol is going to go up, we know how some of these different Greeks behave. And it's going to directly inform the way that we set the straddle up, specifically in terms of expiration. Because when it comes to the rest of the Greeks, one of the cool parts about a straddle is it kind of neutralizes them. Here's what I mean by that. If I go out 21 days and I buy the 683 straddle, let's just eyeball what that looks like. Delta, gamma, theta, vega. This will be for the long call. This will be for the long put. And we'll look at all of these so that we can net them out. Okay. So for the 683 strike, the long call is going to give us positive 51 deltas. Gamma, we're going to get positive 0.02. I'm going to be accurate and do 0.016 just to, because there will be a minor difference here. I don't want to miss it. Theta is going to be negative 0.27. And then Vega is going to be positive 0.65. So that gives me the call metrics. Now let's take a look at the put side on this 683. Our delta is going to be a negative 0.5. Our gamma is going to be negative 0.018. Our theta now is going to be positive 0.195. And then Vega is going to be negative 0.65. So let's take a look at the net position here. This is my net delta. That's my net gamma. That's my net theta. That's my net Vega. So what I'm showing you here is with respect to a straddle, I'm actually neutralizing most of the Greeks. Most of them aren't going to be much. So then what would the next important deciding factor be? If I think through and I know my deltas are going to be about flat, gamma is going to be about flat, theta should be about flat, Vega also should be about flat, like all the Greeks should be about flat. What would I do next? Now, again, this is using a synthetic long. Oh, no, I lied. This is using, I'm sorry, long on both sides. I wanted to look at a synthetic long next. But this is long on both sides. So what's our risk? If everything here... Oh, hold on. Kirk says, how is theta positive for a long option? It's not. Oh, my bad. Sorry. Thank you. I was looking at the put side. And I also did the same thing here. Let me see if I got this right. Yeah, this isn't short gamma. This should all be. Delta is good there. Okay. Now we're good. Now we're Gucci. The main exposure that you have here is Vega. I had a synthetic for part of this because my brain broke out on me. We're long Vega on both sides. Your deltas are going to flatten out. Your gamma is going to be super low because you're sitting at the money. Now, the one thing to note about gamma is that it's going to compound pretty quickly. This is really the major risk. However, the other two massive inputs to this, as you can see, are your theta and Vega. So if I look across and I think, what are the major risk factors to this long straddle? The first one is that if vol doesn't move enough, theta is going to take all my money. The second thing is that if Vega doesn't move quickly enough, theta is going to take all my money. Now, there's a way to try to minimize this through stuff like gamma scalping, but in this factor, the most important thing for us to pay attention to is both gamma and Vega. This is the profit side of the equation. So what this means is if I think S&P vol is going to go up and I buy this straddle, and let's say I do something logical and I say to myself, oh, I want to give myself some time. I want to give myself a little bit of time to be right. So I really, even though I think the move might happen in 21 days, like within that duration, I'm going to go further out. I'm going to go out 77 days. I just want to give myself a little bit more time to be correct. Here's the problem with that. If we take a look at Vega, you'll see that Vega has gone up. It looks better. So now you even say to yourself, well, damn, this is great. Not only have I decreased how much theta I'm paying, but I've also increased the amount of vol sensitivity the position has. That seems like a win-win, doesn't it? But it's fucking not. It is a win-win-lose. Where do you lose? In this scenario, you lose in the fact that vol does not impact all of these terms the same. Vol impacts these near terms more heavily than the more distant terms. So to give you a visualization of this, if we go into SPY and we check out vol, and we just look at raw changes in vol, I'm going to do the 14-day term, and then I'm going to do the 90-day term. What do you notice? They move very differently. So let's take, for example, this spike in vol that occurred from the 8th of this month. Vol went from 10.7 to 18. Decent move for S&P. However, 60-day vol went from 14.9 to 17.8. Significantly smaller move. There is a little bit of a balance because Vega is much higher further out in time. So it doesn't need as much of a move. But you can literally do the math and you can see which of these would have captured this change in vol expectation. So let's do that. We have our Vega. This is using the 21-day options. So let's do another version of this really quick. This one was 21 DTE. Now let's do, what did we pick? The 77 DTE? And we'll go to the 690s and we'll use those. So the delta for these calls, 48. The delta for the puts is negative 0.48. Gamma on the calls is 0.008, and then puts 0.009. Theta is negative 0.153, And then theta is negative 0.102. Vega is 1.244. Vega is 1.237. Now what I can do is look at the changes in these two terms. So I can look at IV, and we're going to look at those two different times. So I'm going to move this off to the side really quick. Actually, right there is fine. No, it's not, because it literally is cutting off the text. So we have 14.9 and 10.7. So here's 14.9 and then 10.7. These expand 18.7 and 20.80. 18.7, 20.80. So I can now see what the overall changes involve between these. And then I can see how much I would have gotten on this change from my net Vega. What do you see? You should see that even though the net Vega is much smaller in the 21-day options, by doing the thing that seems logical, by going further out in time, by decreasing your total theta, by giving the trade more time to work and actually increasing your Vega, you're actually decreasing your overall profit. Now, in this scenario, it made money. So still what we would refer to as a high-class problem. Not that bad. But the difference between these is enough that it's something that I would want to know, because that's a 3.7 point difference. And again, in option speak, that's $370. So as a raw number in terms of theta, I do care about that. That's not so insignificant that it doesn't matter. So that's looking at the concept of a long straddle. What questions do you have? The main things to summarize while you're letting me know if you have any questions is long or short straddles really are going to neutralize a lot of the corresponding Greeks. The main things that they're going to have net exposure is theta and Vega. And then if you're short, it could be gamma, but again, if we're doing 50 delta options, your gamma will be about net flat. The difference is when we're long or short, the way that vol impacts terms matters a lot. And again, that's something that most people don't talk about, because I actually don't know why. Not like that crazy or that nuanced of a concept. I don't think it's like that hard for people to grasp, but people just don't talk about it for some reason. Don't know why. Now, the last thing to pay attention to is your gamma as things move will become skewed. And then that's the part where your straddle and strangle will take on net deltas that you then have to figure out if you want to rebalance the straddle or strangle, or if you want the delta skew that emerges. So theta, Vega, primary inputs, vol across the surface, primary input, gamma, primary input, even though at entry, it's going to be about flat. Yet, as time passes, it ain't going to be flat because things are going to move around. Canadian, hey, yo, thank you very much for the donation. Says, what Greek to time when an option price will likely be cheapest relative to the underlying? I'm wondering whether to buy before closing or wait until next morning for cheaper prices. It's an interesting question. A lot of that will depend on the kind of thing that you're trading and what duration. But in general, after the market opens for like the first hour, 90 minutes, vol is typically higher, and then it will contract into the day. Now, vol sometimes will expand at the end of the day, but it's typically not as high as the beginning of the day. The more important factor here, I actually think, is what profit mechanism we're trading, that the relative difference between beginning of day vol versus end of day vol has a meaningful impact on our trade. Because that's the real question. If our edge or our ability to make money is dependent on that, we probably have to take a closer look at the edge that we're trying to trade. That question aside, between those two scenarios, if I were to buy an option, I would do it towards the end of the day versus the beginning of the day. In general, most of my trading is done towards the end of the day versus the beginning of the day. And it's just because a lot of the factors of when the market initially opens. There are specific profit mechanisms that I'll run earlier in the day, but most of my activity is later in the day. Let me know if you have any follow-ups. Ehaj says, how do volume of either option contracts bought or sold or volume of shares affect contract price? Other than impact to supply and demand, then that's really it. That's the volume itself of the options isn't going to move much other than impacting supply and demand and then what the market makers happen to want on their books. Here's what I mean. We'll find an example. Right here. This is a great example. If I look at the 740 77 days out in S&P, I can see that the size is 301 by 219. So it's bid at 301, offered at 219. Yet if I go down a couple contracts, I can find instances where size is 438 by 1537. So when we're talking about volume impacting price, this is where it would impact price. What this means is if somebody comes in and they grab the 438 options off the bid, then there's going to be a requote. Now, again, there's typically enough liquidity in something like S&P where it doesn't functionally happen in here. This is more specific to thinner traded names, but for the example's sake, that's an instance where volume can have an impact. That said, this is also telling you what the inventory preferences are for whoever's providing this market. What they're saying is, all things else being equal, I would rather pick up, meaning I would rather sell, because they're on the other side of the equation. I would rather sell 1,500 of this option, and I only want to buy 438. So that shows an inventory preference. Now, that can be skewed slightly, again, depending on what supply and demand looks like and what gets consumed and then what gets repriced and reoffered. But again, in something like S&P, not really that big of an impact. It's in smaller names that you'll run into liquidity constraints in terms of like either consuming all of it yourself or in terms of the other parties that you're trading with in that underlying, they also can consume some of the liquidity that then pushes you out. This starts to become a little bit more topical when you have a slightly larger account, because in some of these smaller names, it's not even like you need a huge account. In some of these even moderate sized names, certain options contracts will be pretty thin, which we can take a look at in a sec. Canadian says, follow up. A common scenario is that underlying flash crashes intraday. I'm wondering whether to buy calls that day or will they be cheaper the next day? That really depends on what the flash crash is. Because if it's a flash crash that's being driven by seemingly nothing, that's one scenario. If it's a flash crash that's happening because a new piece of news has come out and has fundamentally changed the market's perception or expectation of that underlying, that's a completely different scenario. Now, between those, and depending on what time the quote unquote flash crash happens, and then what happens after the flash crash also is a factor. Because let's say that there's an intraday plummet that then reverses by end of day, vol will be low. If there's an intraday plummet that continues into the close, vol will be high. And then the next morning, if it reverses, vol might be lower than what it was the close before. So like a lot of things in options, there's not like a blanket thing that you can pick to always do. It is quite contextually dependent on the factors of like what happened and the qualities of what happened. So yeah, unfortunately, there isn't something that you could logically say like, oh, I'm always or I'm generally going to do this thing here for those kind of movements, because it is super, super dependent on what actually happened. Now for EHODG, let's take a look at some other options chains really fast. Here, it's a literally perfect example. In GE 77-day options, this is bid at 13 size, offered 10. You can consume that super quick. So if you do, or if somebody else does, or a combination thereof, that will cause price to move in some way if there isn't another market maker or liquidity provider that's interested to step in at those same prices. So it's really these thinner names or thinner contracts specifically that have a little bit more of that factor. All right, we have a couple minutes left. I want to summarize a couple of these things really quick. When using the Greeks to make trading decisions, I would argue the more important factor is to take into account how the Greeks behave in general. So what that means is understanding how the Greeks behave with respect to time, with respect to moneyness. Those are really the two main things. There's definitely more, but if you have a really sound fundamental understanding of how the Greeks behave in those two contexts, you're pretty good. Like you're in a pretty good starting point. Beyond that, once you understand the specific profit mechanism that you're trying to trade and the way that that thing behaves, then you use that information of the Greeks to set up something that then best captures your idea. Like we were talking about with the long straddle. If I wanted to trade that change in anticipated vol, yet I go out too far, I'm actually dampening my realization of that move. Yet, if I go too close in time and the move doesn't happen quick enough or with enough magnitude, understanding Vega against theta, I can still lose money. So it's about finding a balance that gets you closest to the optimal expression for your idea. Another example of this is if I wanted to buy a long option because I think something is going to go up. Depending on how much I think it's going to go up and how quick that move might happen will have a pretty profound impact on what option, what call I choose to buy or what put I choose to sell. The way that you get to a good place with these is by first spending the time looking at charts like this. And actually, I think it makes a lot of sense to create your own. Just like I do these little back of the napkin charts on the streams with you guys, you can do your own versions of these. And I actually think that it makes a lot of sense to do your own versions of these. Because by doing this stuff, you build a much better intuitive understanding of how, for example, Vega behaves across moneyness and across terms. Same thing with Gamma. I can get a better understanding of those specific Greeks and how they behave. Once you have that down, the rest of the decision making really becomes kind of easy, because then you say to yourself, well, I think this underlying is going to move a whole lot in the next 3 days. So probably not going to sell a put, because I understand the risk profile between puts and calls, and I understand a short put's going to have cap profit potential. So if I think it's going to move a lot, man, I don't want that. I also know that I'm not going to go out 459 days, because if I do that, I get no gamma. And with that glorious lack of gamma, I experience much less compounding of my options. Yet, I might not go all the way into 4 DTE, because when I overlay that gamma against the theta, I might find that if I'm even marginally wrong, I'm not going to see the profit. So you can see how it becomes a broad decision cycle on which options help you build the best structure to express your idea. There's never a point where there's like some sort of optimal Greek. And that's a question that gets asked sometimes. And it's a normal question. It's a logical question to ask, but there really isn't some sort of optimal Greek. Again, just like the example we were going over earlier in terms of times of day to buy, it really is quite relative to what it is that you're trying to do. Kirk says, so on thinly traded options, the repricing could change the option value, irrelevant of the Greeks and stock not moving. Definitely. That's the bid-ask spread. So sometimes, like if we go back to GE really quick, and if I look at the volatility surface, my expectation is I'm going to see different kind of kinks. Shocker. And the reason why I know I'm going to see this is because the bid-ask spread is wide. Does this mean that this kind of near-term kink is actually super tradable? Probably not. This might be. The reason why it might be is because it depends on where the fair value of that option is and where you actually get a fill. Could these two options be a place to look for a relative value play between these two? Sure. But a big part of whether or not this trade actually pans out and works is if you can sell this one at this vol, and then if you can buy this one at this vol. So it's really easy to tell if you're going to see like really kinky options chains, is if they're really a liquid, you're going to find that kind of thing. So the way that the market is offered will absolutely move what the bid ask is. Now, again, that's an inventory preference. The theoretical value will still be what it is. And on stuff that's priced this wide, that's actually what I prefer to do, is I use an options pricing model to tell me what the theoretical value is for, let's say, this option. This 47 delta 312.5 call. It's really wide. It's $1.40 wide. That's not the theoretical value. I can easily calculate what the theoretical value is of this option so that I know at least where I should start trying to enter a trade. Now, a base way to go about that is just start with like a mid price or something close to mid price. But even that can be off by quite a lot, especially when you're looking at stuff like this. That's off like really, really significantly. All right, gang. That wraps me up for tonight. I will see you guys on tomorrow's stream. We're going to be looking at meme stocks as per usual, getting a general stock market update done. If you need anything, hit me up in the Discord. If you're interested in joining in the Pro Plus Zoom giveaway, check out that link that I shared earlier to the Patreon and drop in what you're working on. And I'd love to see you guys there. Be an outlier. See y'all later.